Ever feel like your money is playing hide and seek? Especially when you're trying to build a little financial stability. Like you blink and poof, it's gone, and you're not entirely sure where.
Oh, absolutely. That's a feeling I think pretty much everyone can relate to at some point. The whole financial world can seem like a real maze, especially when you're just starting out.
Totally. And that's exactly what we're diving into today. Look, forget trying to become some kind of stock market genius overnight.
Right.
Our mission here is really about laying down the essential groundwork. Managing your money effectively, whether you're totally new to this or maybe just looking to get back on track.
Hmm.
We've actually waded through, well, a ton of information for you. Articles on beginner money management, those common financial mistakes we all seem to make.
Uh-huh. Pitfalls.
Exactly. And strategies for debt, tax planning basics, saving tips. Even looked at some real talk from people about their own spending habits. So we're aiming for a really well-rounded picture here.
That's the goal. We want to cut through all that noise and confusion, give you clear, practical steps you can actually use right away. No complex jargon, just the useful stuff.
Yes, practical stuff that makes a real difference. Our goal for this deep dive is to arm you with the knowledge and, honestly, the confidence to really take control of your finances without feeling completely overwhelmed.
Right. Avoiding that drowning feeling.
We're after those aha moments,
Yeah.
the insights that make money management feel less like this big, scary puzzle and more like something you can actually get a handle on. Okay, so let's unpack this. Where do we even begin? It really feels like setting financial goals has to be the first step, right? Why is that so crucial?
Well, think of setting financial goals like plotting your course on a map before you set sail. It gives you motivation, for one, but it also acts as your financial roadmap.
Okay.
It shows you exactly where you want your money to take you. Without clear goals, it's just incredibly easy to sort of drift along, spending without a real purpose, and maybe losing sight of what's actually important to you financially.
That's a great way to put it, a roadmap. So what kind of destinations are we talking about here? What sort of goals should people be thinking about?
Generally, yeah, they fall into two main buckets, short-term and long-term. Short-term goals are the things you're aiming for in the next year or so. Like paying off a specific credit card, maybe building up that first small emergency fund.
Got it. The quick wins.
Exactly.
Yeah.
And then long-term goals are the bigger picture things. Saving for a down payment on a house, funding education, planning for a comfortable retirement, that sort of thing.
Okay, so immediate needs and future dreams. Makes sense. Right, so once we have an idea of where we want to go, how do we actually figure out the route? And I guess that leads us straight into budgeting, which I know for some people sounds about as fun as a root canal.
Huh. Yeah, it gets a bad rap. But a budget is really just a plan. It's a plan for how you're going to use your money.
Okay.
Instead of wondering where it all went at the end of the month,
Mm-hmm.
a budget helps you intentionally direct it towards those goals we just talked about.
Right.
And the very first step, the absolute foundation, is understanding your after-tax income. That's your net income, your take-home pay, what actually hits your bank account after taxes, maybe 401k contributions, health insurance. All that stuff comes out first. That gives you the realistic number you have to work with.
Right, because that bigger gross pay number can definitely be misleading. It's all about what you actually have. Okay, so once we know that number, what's next?
The next crucial step is tracking your spending diligently.
Uh-oh. The hard part.
It can feel like it, but it's essential. It means recording every expense, no matter how small. You can use apps, spreadsheets, even just a notebook and pen, whatever works for you.
Okay.
A really effective way is to just regularly look at your bank and credit card statements. They give you a detailed breakdown, often categorized, which makes it easier to see where the money's actually going.
Okay, so getting a clear picture, money in, money out, that feels like the groundwork. Now, are there different ways to actually set up the plan itself? I feel like I've heard about different budgeting styles.
Yeah, definitely. There are several popular methods. One you hear a lot about is the zero-based budget.
Zero-based.
Yeah, the idea is simple. Income minus expenses equals zero. Every single dollar gets a job. Spending, saving, debt repayment, it all gets assigned.
Okay, so very structured.
Very. Another common one is the pay yourself first strategy. This is where you prioritize your savings. You set aside a certain amount right at the beginning when you get paid, before you pay bills or buy anything extra.
Ah, I like the sound of that.
It can be really good if you're pretty confident you can cover your essential bills, and maybe you want something less detailed than tracking every single penny.
Paying yourself first.
Mhm.
It's like guaranteeing your future self gets taken care of right off the bat. Now, speaking of the future and those unexpected things that always seem to pop up, Let's talk emergency funds. We all know we should have one, but it often gets pushed aside, doesn't it? Why is this cushion so vital?
Oh, it's absolutely the bedrock of financial security. It's your safety net. It helps you handle those curveballs life throws.
Mm.
The car breaks down, an unexpected medical bill, maybe even losing your job.
Right.
Without that fund, you might end up relying on high-interest debt like credit cards, and that can just spiral things downwards really fast. Undermines all your other progress.
Okay, so it's like the financial equivalent of a spare tire and a first aid kit combined. How much should we realistically aim for in this fund? Seems daunting.
The general rule of thumb is enough to cover 3 to 6 months of your essential living expenses. Now, I know that can sound like a huge number, especially when you're starting.
Yeah, definitely.
But remember, even starting small makes a huge difference. A really common first goal is just to save up $1,000 as quickly as you can.
Okay, that feels more manageable.
Yeah, or you could look at your current spending, the non-essentials, and see if you can redirect some of that money into savings for a while.
That $1,000 goal is a good psychological boost, I bet. So how do we actually build the habit of saving consistently? What are some practical tips for that?
Building that habit, it really takes intention and a system. So
Hmm.
first, like we said, set a specific goal, that $1,000 or the full 3 6 months eventually. Then automate it.
Automate.
Set up automatic transfers from your checking to a dedicated savings account every time you get paid, even if it's a small amount. Consistently doing it adds up significantly over time,
Right. Set it and forget it.
pretty much. And then check in regularly. Monitor your progress. Seeing that balance grow is motivating. And importantly, celebrate the milestones. Acknowledge when you hit $500 or $1,000. That positive reinforcement really helps you stick with it.
Celebrating the small wins, I like that.
Yeah.
Makes it feel less like deprivation and more like actual progress. Okay, so where should we keep this emergency money? Does it need some special high yield thing, or is a regular savings account okay?
The number one priority for your emergency fund is accessibility. You need to get to it quickly in a real emergency. But you also don't want it too easy to access, so you're not tempted to dip into it for non-emergencies.
Ah, the temptation factor.
Exactly. So a standard savings account at your bank or a credit union is usually the best bet. It's safe, it's insured, it's accessible. You might find slightly higher interest rates elsewhere, but for this money, safety and access trump chasing tiny yield differences. Some people think about prepaid cards or even cash, but those have, their own risks and drawbacks.
Makes total sense. Easy enough for emergencies, hard enough to resist buying pizza with it. Okay, we've covered some really key skills. Now let's shift gears a bit and talk about habits, the things that can either help us or really hurt us financially. Let's start with the bad habits. What are some common ones we should try to break?
Well, one of the absolute biggest and most costly is carrying revolving debt on credit cards, month after month.
Ugh, yeah. The interest trap.
Exactly. Average credit card debt is pretty high, and with current interest rates, just letting that balance sit there costs a fortune over time. The key really is to try and treat credit cards like debit cards as much as possible. Only spend what you know you can pay off in full that month. Avoid those interest charges completely if you can.
That interest just eats away at your money silently, doesn't it? What's another common bad habit we might not even realize is costing us?
Buying food you don't need, or rather, buying food that ends up getting wasted. It's huge. Studies show Americans waste a really significant chunk of the food they buy.
Guilty. Definitely guilty.
It's literally like throwing cash in the trash can.
Yeah.
So try being more strategic. Check the grocery ads, plan meals around sales and what you already have. Actually look in your pantry before shopping.
Right, don't buy a third jar of paprika.
Exactly. And stick to a list. It sounds simple, but it can save you a surprising amount of money.
That hits home. That impulse buy at the checkout. Okay, what about those bills we pay every month, often on autopilot? Any hidden savings there?
Oh, absolutely. Not negotiating your internet and cell phone bills is a big one. Often, just one phone call, maybe mentioning competitor rates you saw online, can lead to real monthly savings.
Really? Just asking.
Often, yes. And another thing is staying at the same retirement savings rate year after year. Many people set it when they start a job and never touch it again.
Mm-hmm.
Even just increasing it by 1% each year can make a massive difference long term. Lots of plans even have an auto escalator feature now that does it for you. Plus, keep an eye on those IRS limits. They usually go up, meaning you can save more.
Those feel like relatively easy wins, just needing a little effort. Any other sneaky bad habits?
Yeah, a couple more. First, grocery shopping without checking for digital coupons. Most stores have apps now with digital-only deals.
Yeah.
It takes a few minutes before you shop, but it can add up to hundreds in savings over a year.
Wow, okay. Digital coupons.
And second, booking vacation rentals. Don't just look at the big third-party sites. Sometimes booking directly with the owner or property manager can save you a lot on those platform service fees. People have reported saving like a significant percentage, even thousands in a year sometimes, just by booking direct.
Whoa, those platform fees are no joke then. Okay, so we know what not to do. Let's flip it. What are the good habits we should be actively trying to build for a healthier financial life?
Okay, top of the list, prioritizing debt payments, especially high-interest debt. Start by listing everything you owe, interest rates, balances. Then pick a strategy.
Strategy.
Yeah, like the debt avalanche, you hammer away at the highest interest rate debt first, saves the most money overall, or the debt snowball, you pay off the smallest balance first, get that quick win, which would be really motivating.
Avalanche versus snowball. Got it.
Whichever you choose, consistency is the absolute key. Setting up automatic payments helps make sure you never miss one and stay on track.
Consistency. Seems to be the magic word here. What's another good habit that supports everything else?
Tracking your spending regularly. We mentioned it for budgeting, but it's not just a one-off task. It's an ongoing habit.
Right, keep doing it.
Yeah, it gives you constant insight into where your money's really going. Lets you spot patterns, see where you might be overspending, or where you can maybe adjust things to meet your goals faster. Even just a few minutes each day looking at transactions makes a big difference in awareness and control.
So it's not about feeling restricted, but being aware and intentional. Gotcha. What other regular things should we try to do?
Regularly review your recurring charges, subscriptions, memberships, especially those that auto-renew.
The subscription creep.
Exactly. Go through your statements every few months, cancel stuff you don't use anymore. It can free up a surprising amount of cash. Also, just making a conscious effort to cook more meals at home instead of eating out all the time. Plan meals, maybe look up local restaurant deals for occasional treats, but home cooking saves a lot.
I can definitely find a few subscriptions to cancel, I bet. Any other key habits?
Yes, two more good ones. Before you buy something non-essential, give yourself a waiting period. A few days, maybe a week.
The cooling off period.
Right. It helps you tell the difference between an impulse want and a genuine need. Lets you think if it really fits your goals. And finally, don't be scared to negotiate bills. Car insurance, credit card rates, gym memberships, cable. Research what competitors offer, then call your provider. Often, they'd rather give you a better deal than lose you as a customer.
Those are all super practical, things you can actually start doing today. Okay, let's pivot one last time. Investing. This can feel like a whole different language for beginners. What are some basic principles people should get right from the start?
Yeah, investing can seem intimidating. First off, before you even think about specific investments, you need to define your goals. What are you investing for? And understand your own risk tolerance. How much fluctuation in value can you stomach for the potential of higher long-term returns?
Goals and risk tolerance.
And critically, shift your focus from past performance to future potential. Just because a stock did great last year doesn't mean it will next year. When you're looking at a company, its potential for future growth is way more important for its future stock price than its recent history.
That's a really key point. Future potential, not past glory. What's another big principle for new investors?
This one's tough, but it's about knowing when to buy and, maybe even harder, when to sell. A super common mistake is selling winners too early because you get nervous.
Locking in profits.
Yeah, but maybe too soon. And then holding on to losers way too long, hoping they'll bounce back.
The hope strategy.
Right. Successful long-term investing often means having the patience to let your winners run, assuming the reasons you invested are still valid, like the company's growth prospects. Peter Lynch, the famous investor, talked about finding 10-bagger stocks that went up 10 times and needing the conviction to hold them through ups and downs.
So it's about that long-term view and tuning out the short-term noise. What's the overall philosophy then for long-term success?
Look, successful investing over the long haul isn't about hitting home runs constantly or trying to perfectly time the market highs and lows. Nobody can do that consistently.
Right.
It's about consistently applying time-tested principles. Focus on quality investments for the long term. Do your homework. Understand what you're actually buying. Don't just chase hot tips. And maintain discipline, especially when the market gets rocky. Don't let emotions drive your decisions.
Quality research discipline. Sounds much more sustainable than chasing hype. Okay, so what are some specific investment options that are generally good for beginners and why?
Yeah, there are several good starting points. dividend reinvestment plans, or DRPs. They let you automatically reinvest dividends back into buying more shares of the same stock. Creates that powerful compounding effect.
Okay.
Retirement accounts are huge. 401ks, traditional or Roth IRAs. They offer major tax advantages for long-term saving.
Yeah.
And if your job offers a 401k match, that's free money. Absolutely take it.
Never leave free money on the table.
Never. Exchange-traded funds, ETFs, are another great option. They trade like stocks, but usually track an index, like the S&P 500. So you get instant diversification across lots of companies, which lowers your risk.
ETFs for diversification. Makes sense. What else is good for starting out?
Index funds are very similar to ETFs. They also track market indexes, are passively managed, meaning no manager actively picking stocks, just tracking the index. Historically, they've often performed really well, even compared to actively managed funds, and they're simple, low cost, maybe the most profitable, effortless route for many.
Index funds. Simple and effective.
Blue chip stocks, shares of large, stable, well-known companies with reliable performance, often paying dividends, can be a solid foundation too. And dividend stocks generally provide regular income you can reinvest. Look for dividend aristocrats, companies with super long histories of increasing their dividends like Coca-Cola, P&G, Walmart.
Dividend aristocrats. Nice title.
Isn't it? And if you have a high deductible health plan, look into a health savings account, an HSA. Triple tax advantage contributions are deductible, growth is tax-free, withdrawals for medical expenses are tax-free. It's amazing. And for more conservative folks, municipal bonds can offer tax-free interest income.
Wow, lots of options there. It sounds like diversification, low cost, tax advantages, and reliable companies are key themes for beginners. Now, flip side, what should beginners be cautious about? What investments should they maybe avoid at first?
Definitely avoid making decisions based only on past performance. We said it before, but it's critical. What did well last year might tank next year. Also, trying to time the market, buying at the bottom, selling at the top, is basically impossible consistently. Don't even try.
Okay, no crystal balls.
Exactly. And be super careful about fees, trading commissions, account fees, inactivity fees. They can really eat into your returns. Many brokers offer commission-free trades now, which is great, but always check the fine print for other costs.
Fees can be sneaky. What else should beginners watch out for?
Investing without clear goals and knowing your risk tolerance. That leads to emotional decisions, like panic selling when the market dips. That's usually the worst time to sell. And finally, cryptocurrencies.
Crypto.
Yeah, it's a very different beast than stocks or bonds. Different rules, not the same regulations, and they can be incredibly volatile. Huge swings up and down. The potential returns look tempting, sure, but the risk of big losses is also very real, especially if you don't truly understand the tech and the market dynamics. Also, things like wash sale rules that apply to stocks don't currently apply the same way to crypto, which affects tax loss harvesting. It's complex.
Volatility and complexity definitely sounds like something to approach with caution, especially early on. Seems like building that solid foundation with more traditional stuff is the smarter play for beginners. Okay, well, we have covered a ton of ground today. From getting budgeting basics down to building good money habits, cutting out the bad ones, and dipping our toes into investing. These really do feel like the essential building blocks, don't they, for feeling more in control and building long-term financial well-being. They really are. It boils down to taking those first steps, making informed choices, and then just consistently applying those good habits. That's what sets you on the path to a more secure, more confident financial future. It's not magic, it's process.
Absolutely. So as we wrap up this deep dive, here's something to think about. What's one small, actionable step from our chat today that really resonated with you? Something you feel ready to rethink or maybe start doing, like right now, in your own financial journey? What's one money habit you're inspired to maybe break or perhaps build starting